Hello and welcome to our first end of year review. I thought it'd be useful to pull together some useful figures and insights from this year. It's been a momentous year and a very challenging year for HR and reward departments. And I thought this might help sort of summarize things. So we've got quite a lot of pay trends from last year through to this year and then into next year, which I thought would be useful. Some other HR and trends and business insights. And then finally talking a little bit about what's been keeping people busy in the profession and what people will undoubtedly keep busy into next year as well. So looking on to the pay trends, so you can see from this government statistics on average earnings, there's been quite a big effect of COVID over the last 2 years. So sort of summertime in May 2020 onwards, certainly the private sector and the whole economy average earnings figures took a huge dip. Obviously, a lot of organisations furloughing staff as well, and having a major influence on earnings at that point. You can see the public sector, the orange line there, sort of holding up. Then you look at fast forward 12 months, and that had an indirect influence on average earnings 12 months later. And that's where you can sort of see the huge blip on the private sector and the whole economy this May and June and July. So that had a big influence on figures there. And there was an influence on the public sector, which was the sort of exact opposite of the private sector. I think what you've seen is over the autumn time, the figures come back to a bit more consistency, sort of pre-COVID rates and pre-COVID levels, really. I think the big statistic which people have been looking at, particularly looking forward to next year's pay awards, is inflation. And it's been flat for most of 2020 and quite at a low level, and then sort of since March, end of springtime, and Easter this year, it's shot right up. And the quote there is from the MPC talking about expectations to rise above 4%. And the November figures, which were released yesterday, indeed show that the CPI just went was 5.1%. So that's now above 5%, and that's having a big influence on collective bargaining discussions, negotiations with trade unions. Obviously, the biggest influence on there is sort of the energy prices, the wholesale gas price rises that we've seen, which we all obviously having to suffer as well. And so that's having a big impact. I think going forward, the MPC expect it to be maintain around the 5% level between January and March in 2022. So that's obviously having a big influence on some people's pay award discussions. So looking at pay this year and indeed last year as well. Last year, pay awards centered largely around 2%. So you can see the mode, the most common pay award in 2020 was 2%. And you can see the range there between 0.7 and 2.5. Reality is most awards in 2020, if they did go ahead, were at 2%, but there were some at 1% as well. Looking ahead to this year, again, most seem to be 2%, and a similar sort of range, really, 1 to 2, just over 2.25% there. But the most common review again this year was 2%. I think the biggest difference between this year and last year was there was almost a quarter of organisations had a pay freeze. This year was 16% of organisations. Now that's still pretty high. We normally only see in our figures a pay freeze of for about 1 or 1.5% of organisations. So still a substantial number having a pay freeze this year. There were some sector differences in pay in these figures, not huge, I would say, but facilities management and construction consulting and healthcare saw perhaps the biggest pay increases, pay awards this year, and very much down to sort of sector pressures, market pressures. Facilities management tend to be a bit more stable as a sector anyway. Most awards in our database seem to be January or April. July is quite common as well, but January and April seem to be the most common. And interestingly enough, when people made predictions about this year, what they were going to pay, it ended up as they originally planned as well. So that's very much the picture for last year and this year, a pay award of essentially 2%. What that also, I guess, perhaps disguises as well is what people pay outside of the pay awards, and we've been tracking this for a number of years. At the moment, certainly last year, the median out of cycle figure was just short of 1%. It was 0.8%. You can see there. So that's 0.8% of the pay bill, and the median this year was 1%, and that's a little bit down on pre-COVID levels. So not a huge out of cycle increases at the moment, although 3/4 of organisations did see some form of out of cycle increase this year. Construction consulting again, but also other areas of construction like building and civil engineering saw the highest out of cycle increases. I would say our figures shown here are slightly lag because as the year has gone on, the sort of pressures from the external labour market have increased, and so these are sort of I guess in a way if we took the same figures at the end of the year, they might be a little bit higher than that. But they represent what's been seen this year. I think as you can see, the biggest driver for out of cycle at the moment is market pressures, perhaps unsurprisingly, but there's also a certain amount of internal pay alignment as well. So people looking at internal pay equity and outside of the cycle, looking to make adjustments there to try and make perhaps their gender pay reporting figures better, and address any sort of inconsistencies. So that's the out of cycle increases, and it'll be very interesting to see what happens with them next year as the sort of pay pressures continue to build into the new year. So on to next year then, in terms of pay predictions. And at the moment, since we've been collecting this information since August, the range seems to be 2 to 3% as a pay increase for next year. 2.5% median indicates there's a lot of 3% increases in the predictions. Having said that, our market database is currently showing 2% as the most common prediction for next year. But it's interesting that we are starting to see more 3% and above increases, no doubt influenced by inflation. A much lower number of organisations predicting a pay freeze next year, so only 2.8% of organisations, if you recall, compared with 16% this year. And what's interesting is that 10% of organisations have changed their prediction from August through to the sort of end of the year, and we've tracked this, and they've generally gone up by 0.5%. And I think that's been the influence of the external labour market, and obviously the inflation figures as well. So if people were thinking 2.5% as a median, perhaps they're thinking 3% now. Now we've not seen that change our overall figures here, but I suspect as we come to more pay awards at the start of 2022, we'll find 3% will probably become the most common pay award for next year as we go through the year next year. So that's my prediction, really. We end up at 3%. Okay, then on to some useful business insights as well. So we ask organisations, what their predictions are in terms of orders and revenue and profitability for the next 12 months. And this is the percentage of organisations. It's from our UK Rewards survey. And the orange indicates that most organisations, at least half, if not more, expect orders and revenue and profitability to increase. Profitability is slightly lagging behind because there are pressures on costs, particularly payroll costs, of course. And a good number expect the sort of outlook to be about the same as this year. So these figures, if you can see, there's a very small proportion in the dark blue of people expecting orders and revenue and profitability to decrease. That though there was a lot more dark blue on the grid when we asked this question this time last year, and so it's obviously moved in a positive direction since last autumn. So that's the sort of business outlook, generally positive. Onto the labour turnover figures, and it's really interesting looking at these. The overall figures at the moment, 15% median and 10% voluntary, and that's an increase from the springtime. We had 10% in the spring and 7.5% for voluntary in the springtime. So that's probably reflecting what's happening with the labour market. Again, these figures were collected over the autumn time, over sort of September and October largely. And as the year has gone on, the sort of increase, the labour turnover people have reported has gone up. They predict it will continue to go up in the next 12 months. So you can see the largest proportion of organisations, 47%, almost half, say that they expect labour turnover to increase. Interestingly, still there's a good proportion, just over 20% expect it to stay the same. But there's obviously a lot of don't knows in there as well now. I think that's sort of indicating what's happening with the market, and it's something that we'll keep a close eye on for you as well into 2022. We asked also questions about, are you experiencing recruitment and retention challenges? And the percentage of organisations who are experiencing them have gone up quite significantly. The figures in springtime were, I think, between sort of 20 and 30% of organisations. And you can sort of see in the last 6 months, 42% have experienced problems retaining people, and a higher proportion, 54%, just over half, experiencing difficulties recruiting people. And it seems to be, anecdotally at least, that's what people are telling us, it's the recruitment of the right sort of skills and talent which people are struggling with, and they'll continue to struggle with. I can really only see these figures going up and more organisations finding challenges as we go through into next year. In a normal year, we normally see this at between sort of 2/3 and 3/4 of organisations stating that. So we're not quite there according to these figures, but I suspect we will be back to sort of pre-COVID levels very, very shortly in terms of these sorts of challenges. 39% of organisations said that they're having to pay a premium to recruit new people. That's obviously has an impact on pay equity, because that means that they're paying people salaries that conflict with what their current people are paying, or they're paying their current people on the same jobs. And actually, it's interesting that half of organisations are quantifying that premium as 20%. What's been interesting is that some organisations anecdotally have said, actually, the reason why we're having to pay a premium is because people don't want to leave their current jobs. There's still a little bit of reticence in terms of losing a bit of job security there, and they want to stay put a little bit longer. And that's been one of the reasons. There's obviously a lot of there's a sort of lack of key skills in particular sectors, and for sort of particular skills as well. So that's obviously having an impact as well and driving up pay increases as well. So recruitment and retention challenges, that's rising. That's a very different picture to last year. And these are the sorts of jobs that people are finding pressures in the market. So in IT, people have talked about cyber security and sort of generally user support. Development roles, I think, are also some people have mentioned. Maintenance, definitely. The trades, a lot of trades, electricians and plumbers, real shortages there, particularly around people going in, rather than moving to other employers, actually starting up themselves and doing sort of one-man bands, basically doing the work themselves. Construction, it's probably the usual suspects of QSs and planners and project management roles, so the sort of professional type roles. Healthcare, definitely things like matrons, and certainly nurses are in there as well. Real problems with carers, and that's real skill shortages for carers, and that's maybe driving up pay to a certain extent, but obviously there's an affordability issue in the residential care market, but that's where pressures are as well. And then just generally speaking across all sectors really, things like finance roles in HR, some in the housing association sector and house builder sector, development type roles as well. There's premium charge on those roles. So those are some of the areas people are finding recruitment retention challenges. And just coming on to what's keeping people busy, what they tell us are keeping them busy. The recruitment retention pressures are having a sort of focusing people's minds on the benefits they're doing, and a lot of organizations reviewing what benefits they offer and thinking a bit more strategically, holistically about what they're doing on the benefits side. Obviously, the new ways of working, the hybrid working, is having a big focus, and has done since at the start of COVID, but particularly managing that sort of split workforce between for some organizations where they've got location-based, work-based staff, and then they've got home-based staff, and ensuring that the two sort of are aligned and you don't and engaged, and they're sort of together as one, essentially. Employee health and well-being, when I asked the question, that's still very much on people's agendas. People are very conscious about the long-term impact of COVID, and needing to stay on top of that, looking after their people. And also this year, as the year has gone on, and perhaps there's been less sort of things, I think, COVID issues, as in furlough and such, people have been looking at other parts of the HR agenda, and diversity and inclusion. The EDI agenda is definitely up there. People looking at that. I came off a call from this morning, and that was definitely on people's agendas, looking at that whole piece. Ethnicity pay gap reporting, people have mentioned they're starting to look at getting the figures together for that. Whether they choose to publish it or not is another example, issue. So, EDI is sort of the current agenda items. There's a lot of these are the sort of most common reward projects that we've been working on. So we're very busy on the benchmarking side, and I think a lot of organizations wanting to do ad hoc benchmarking of some specialist roles where people essentially are asking for pay increases and they need some evidence to push back, or looking at particular locations where there's some difficulties in recruitment, difficulties as well. Obviously, this time of year, company-wide pay review cycles are driving a lot of benchmarking work as well. What's been interesting is that, over the course of this year, people have been looking at their pay structure, so creating a fair and transparent pay structure. So that's been really interesting. Then also taking a step back and looking at just their general approach to a reward, and developing a strategy or their principles, to make sure that as an organization, they are aligned to where you want to go to as an organization. So lots of people doing reward strategy and that sort of thing. What sort of tends to drive out of that strategy, or to support the pay structure piece, is job evaluation. And we are very busy with job evaluation this year, much more so than last year. So people wanting to either put in a grading structure because they've got nothing, or indeed review what they're currently doing at the moment. And then lastly, I guess linked to that sort of whole benefits piece, people looking to communicate the sort of benefits offering, sometimes because organizations may not be able to afford pay to pay what's going on in the market. So it's around communicating and looking at what other parts of the reward package do they have, and so and improving the communications of the other package. So we've been very busy on the total reward statement side and creating branded statements for people. So those seem to be the sort of the key areas where people are looking at the moment anyway. And then just looking looking on next year and beyond, just to sort of, I guess, summarise, I think labour markets pressures are going to continue, and that's going to hopefully probably drive a need for benchmarking and accurate benchmarking. So that's looking at, what are people paying as opposed to necessarily what's in the recruitment websites. Retention, is that going to become more of an issue? Obviously, recruitment is an issue at the moment, but actually, are people going to start to see retention being an issue? And obviously, people's predictions are that labour turnover will go up next year, so that would back that up. But also actually to try and counteract that, maybe a bit greater focus on pay equity and pay progression. So linking that back to that pay structure work again. So making sure that the employees can see where they're going in terms of pay progression. Also that focus on total rewards. So looking at the other benefits and producing TRSs and doing things like that, and to try and retain staff. I think COVID's going to continue having an impact in the economy next year and on employees as well. So, to varying degrees. So obviously, certain sectors like hospitality are currently finding it very difficult, and I suspect, but other sectors have been able to keep working through and maintain as well. Construction have been very good at doing that, for example. So I think that the COVID will have an impact, but to a greater or lesser extent, depending on the sort of sector and the type of work being carried out. Hybrid working, I think organisations will continue to evolve their approaches. They've, by the end of this year, people have got a pretty good steer about how it's working and where it was going to get to. But there are a lot of organisations out there where there was still a lot of people waiting to or due to come back into the office and commence working again. So I think it's not until we start seeing us getting through cases drop and restrictions ease that we'll start to see approaches evolve and get to a bit more of an equilibrium of what it's going to look like going forward. So that's probably expect that later on next year. Health and well-being, I think that's still going to be on the agendas, and particularly looking at those sort of longer term impacts and effects of COVID from the past 2 years, and that's going to continue, I think, into next year as well. In terms of pay, I think the predictions are the highest they've ever been for over a decade. So if we're looking at a 3% pay award, that's the highest it's been for a long time. I think the influence of inflation in Q1 is going to have an influence on pay awards for a good part of next year. I think more employers are likely to, because of affordability and because of recruitment retention challenges, they're looking to differentiate their pay pots. So rather than do a 3% across the board, they'll probably be looking more likely at having a 2 or 2.5%, 3% pay pot, and then dividing it up to largely around people who are adding the most value, who are performing basically. Out of cycle increases, I suspect they will accelerate. They were 1% this year. They might go as high as 2% next year. So we might see sort of annual pay movements of a 2% out of cycle, a 3% pay award. So maybe 4 to 5% movement over the course of the whole year next year. So that will have an influence as well. As will, obviously, what I've not mentioned so far is the 1.25% increase on national insurance contributions. That is going to have an impact on people's affordability as well. And then finally, labour turnover. I think as people seem to predict that it's going to continue to rise. I think there's going to be a limitation factor on in some cases where employers experience only isolated market pressures. So some organisations have said to us, yes, they've got pressures, but only in sort of small numbers of roles. So they won't likely see a huge increase in their overall labour turnover figures. In other sectors where there's huge pressures, a lot more, construction, house building, I think there'll be more significant increases in their overall labour turnover figures. So there'll probably be a bit of a mix there, but generally speaking, I think we'll see them overall rising next year as well. So That's the concludes my roundup of the year. I hope you found it useful. Thank you very much for attending all our HR workshops and our webinars this year, and filling in all our salary surveys and our UK reward surveys. I hope you have a very happy Christmas and New Year. Stay safe, and I hope to see you next year as well. So thanks very much then, and take care. Bye-bye.